Last year, you made 100. And now, because of depreciation and inflation, we're saying that to get the value of the same 100, you need to do 115.
Yes.
So invariably, they haven't actually upped their revenue. It's like you are collecting the same value for us.
No, at 110, they are collecting the same.
Yeah, exactly.
But at 115,
okay, at 110,
they are not collecting. Yes,
exactly.
But at 115, they are not collecting the same. They are growing.
So they've grown by a percentage thereabout.
But there's another reason you may also want them to grow bigger.
Okay.
One, not enough people are paying taxes. Two, you have become a middle-income country. You are no longer getting grants. You are no longer getting soft loan, what you call soft loans. So you are borrowing at rates that are higher than you used to borrow before, right? So you would want GRA to increase what you call the revenue effort, to bring in. So now you are looking at your middle-income countries, right? You are looking at countries like Korea, because you are slightly below. You've left developing, but you have not also reached full middle income. But you are setting a target. Lower middle income. That's where expression comes. But so you are looking. Let's say in Africa, you are looking at South Africa, which is a middle income country. The well-known one in Africa. Or you are looking to Middle East. You are looking to, when you see their development to reach that level, GRA will have to. Here, there is something in the economy which is not making us, which is informal, which is not throwing them out. So you supply them, in this case, with electronic means of identifying taxpayers when they do trading and others, so that you boost your revenue from, let's say, 15% of GDP to 17.5%, which is where top African countries are, and we used to be there because of rebasing, or even to 20 plus, which is where the middle income countries are. So here is a genuine effort. But that type of increase takes time. So you give them 3 to 5 years. And that's where they do their strategic plan. They tell you how they are going to do it, the investments they will need. But back to revenue and expenditure. So you will see that where our revenue is 110, okay, it should have been 70 from the example. From the real budget.
The real budget is talking about 72 billion.
Yes, but so where you are at 70, right? Remember that we did 63.
Sure.
And even we did 53 because of COVID. We would explain COVID crisis and others and how they affect the budget. I don't want to confuse it with this. So it is a stretch to come from 53, 54, which was a revised target for COVID.
In the medium budget last year.
To reach the original budget level of 63 billion, which was in the 2020. That was original.
Original, yeah.
And then add another 10.
10, which then brings you them to the
73. Yes.
72, 73.
73, yes. Yeah. There's a 73 to simplify it, because 63, 53, 63. So let's assume it's here.
73, okay. Right. Because it's 72.5.
Exactly. So you are telling GRA, we gave you 63, but on account of the fact that COVID came, the airport was closed, businesses were shut down for a period, and even now businesses are not returned to their fullest. We think with the recovery that is coming, you can do 63, back to where you should have been last year. But we also think that with vaccine and others that have come, right, if you had done the 63 and the recovery gains steam, we wouldn't be at 63, we would probably be at 73, or maybe 68. Okay, so this is the sort of, discussion that goes on in budget discussions with GRA and the other institutions. Remember I said non-tax and others. Well, so some of it all is, are we able, because on current performance, as you said, we are, remember what I said of households and governments. You should be able to cover wages and allowances. It's the two that we call compensation. For those who may want to know. When you add the two, then it's compensation. Another, employee cost.
Yes.
It's total compensation.
Total compensation, yeah.
You should be able to cover that from your tax revenue. You should be able to cover interest from your tax revenue.
But
you should be, yes, I'm coming to you. Yeah. So let's bring the audience.
Bring it, yeah.
Yes. You should be able to wages and allowances from your tax revenue or your revenue. Interest payments from your revenue.
Same revenue, okay.
Running government offices and
From
other
your
things
revenue.
from your revenue. Repayment of old loans, amortization from your revenue.
Matured ones.
The matured ones.
Okay.
If at that point you begin to borrow, it is logical because most borrowing is for capital.
So you say that's
it's for
sustainable.
development expenditure.
Okay.
So that is sustainable, provided you continue to perform that way, and your interest and the debt repayment will be covered, will continue to be covered. The situation we are in now is that those two items, interest and compensation, right, are already exceeding tax revenue.
Tax revenue.
And they are about 98 or 95%, or so, certainly above 90% of total revenue, which includes grants. But the reason why this itself is as dangerous as going beyond your tax revenue is that you are talking about gross revenue. There are certain statutory payments that we have to make from that gross revenue. You have to pay, you have to give money to Get Fund, you have to give money to NHI, you give to, we sometimes do total budgeting. So those expenditures can be part of the expenses side. If it's part of the expense side of the budget, fair enough. But like state-owned enterprises and the rest, it's not always part of it, right?
You always separate them.
You may separate them and all that. So this is where things become dicey. The things that we should normally pay from our total revenue or tax revenue, we are beginning to have difficulty.
Now we have to borrow to finance those
and the
things.
the two big ones are repayment of the debt, assuming that interest is being covered, the principal element, and then running government offices. Because remember, you've exhausted your tax revenue or your revenue on only two items, which ordinarily should be. And when you get to these points, you have to pull back. It's like right. And so the situation where COVID comes to worsen, makes things worse for you, right, requires more belt tightening. Let's go back to household.
Yeah.
If daddy loses a job, maybe on account of COVID, which is not bringing government the revenue.
For a loan to buy a car.
Yes.
And there's repayment going on.
Right.
It becomes a big deal.
Yes. So you cut down on entertainment, right? The kids were at home on account of COVID, but it's not every crisis that brings the children home. They will continue their schooling. So you prioritize areas where you think. And if you can go to the bank that knows and you are capable, you can go and tell the bank, I'm left with 3 years to pay. I'm left with 2 years to pay my loan. But here I am, I don't have, stable income. I'm only now helping my wife, and, so they will ask you, so how much do you think you can pay? You negotiate, and then maybe they add another 1 year. They lower the amount that you have to pay because they've extended.
Yes, okay.
And countries go through the same. So often we do the tightening ourselves. But the tightening that has to be done has to be, one, remember, you may not be generating revenue sufficiently, whether because you have a large informal sector or because COVID has hit. As COVID recoveries come, it's like a global financial crisis. It's like when cocoa prices fall. When they start to rise again, then GRA has to do their thing. Others who bring in revenue, DVLA and the rest have to do their thing, so that we come back to a situation where we can meet those expenditures. If you are borrowing to pay interest and you are borrowing to pay debt, old debt, right?
Is that a good thing to do?
No. That's when your debt becomes unsustainable.
Why?
Because you are adding to debt. You are not paying it down. And that's why it moves from 50% to 60% to 70%, 80%.